Hello and a warm welcome to the La Trobe Financial June Investor Call. I'm Michael Watson, Head of Distribution Asia Pacific. Thank you for joining us. Throughout each of our investor webinars in 2021, we've reviewed the current economic settings and updates while remarking at the extraordinary pace of the economic rebound playing out before us. Of course, it is important that with all the noise and volatility in the market, that investors are reminded of the underlying fundamentals that will make a difference to their investments. In each of our investor webinars, we've also cautioned that this remarkable rebound was set against the backdrop of residual pandemic risk, and indeed our June update is no different. To paraphrase from statements we've made continually throughout our webinars, there will be bumps in the road on the path to economic recovery. As we'll demonstrate through this update, the Australian macro outlook remains remarkably strong. Even with continued lockdowns in key locations nationally, our rebounding economic outcomes have surpassed almost all reasonable expectations and indeed have our economy already larger than it was before the pandemic. In last month's webinar, in addition to our usual portfolio and property and economic insights, we provided an overview of our asset class, its size, its breadth and its depth, and how property credit can form an integral part of a diversified income portfolio. In this month's webinar, we'll take a deeper dive look at the assets of our portfolios and the value of diversification. Who are our borrowers? Why do they come to La Trobe Financial? What are some popular myths and misconceptions? And how we allocate assets to create fully diversified, inflation-responsive portfolios that perform across the cycle with monthly distributions to meet income and lifestyle requirements. Today, you'll be hearing from key wealth management executives to assist in relaying our thinking and insights. Lillian Chin, our Director of Client Partnerships, brings over 21 years of experience in the domestic and international private banking industry, with a stellar track record as a top banker. Lillian has been a regional executive in Westpac Private Wealth and has worked for Merrill Lynch, HSBC and Citibank in Singapore. Troy Stratton, our Deputy Chief Investment Officer, has 20 years experience, both in London and here in Australia, across banking and wealth management. Troy has worked in senior roles with Barclays Wealth, Barclays Private Bank and HSBC Retail and Wealth Divisions. And finally, to me as Head of Distribution Asia Pacific. I've been with La Trobe Financial now for nearly a decade and have worked within various market-facing roles and project roles. I have an MBA, plus economics, marketing and financial planning qualifications. My previous roles have been across bank and non-bank financial institutions within credit analysis, portfolio management and operations. As with each of our investor calls, we'll start with a brief corporate update. With over 53,000 investors and growing monthly, these investor calls are a great opportunity to update existing investors while providing an overview to connect with those investors who might be newer to us. La Trobe Financial is a diversified Australian asset manager operating two distinct revenue growth engines, being asset management in the $3.3 trillion managed fund sector and real estate credit finance in the $2.4 trillion Australian residential and commercial mortgages market. We're a portfolio company of the US $649 billion Blackstone Group, who own 80% of the business, with the remainder owned by senior management. The business of La Trobe Financial is managed by experienced hands. Our CEO, Deputy CEO and Senior Vice Presidents have an average of more than 17 years experience at La Trobe Financial, in addition to broader industry experience. Our real estate credit finance assets are originated from over 3,500 accredited mortgage brokers, and our credit fund is supported by over 1,600 individual financial advisory practices nationally, in addition to our broad and wide domestic and international investor network. It must be noted that our deep networks across asset origination and funding sources gives us unmatched resilience against market volatility at all times across the cycle. La Trobe Financial also has unparalleled diversity within its funding, with our retail asset management, institutional mandates and debt capital market exposures a standout in our market. In short, La Trobe Financial is optimistic about 2021 and beyond. The business is financially strong, with quality assets in our portfolios and are set to continue on the success built on many years of ensuring diversification remains at the very core of our business. A focus of this month's investor call is to answer a very common question we are asked. Who are your borrowers? It's a great question and one which we're very happy to answer in great detail. Let's start at the beginning. You'll remember from last month's webinar, we addressed the size of the property credit market with some $2.4 trillion in total assets, making it larger than the entire Australian Stock Exchange. This market provides opportunities for some $600 billion of new loans written each year. Broadly, the large banks service this market really well. However, on average, around 20% of these assets might consider or benefit from a loan via a non-bank lender. Because of the size of the asset class, this equates to $120 billion of new loan opportunities each year in the non-bank space, a truly enormous runway of opportunity. Within this $120 billion per annum, there are an array of reasons why borrowers may seek finance. Some borrowers, and studies indicate up to 17% of them, in fact have negative views on banks and actively prefer to deal with asset class specialists. Now, 17% may not sound like a lot, but it's over $20 billion in high quality lending opportunities each year. La Trobe Financial provides loans to high quality borrowers who are underserved by the mainstream lenders. By that, we mean borrowers who have an excellent credit history, a creditworthy requirement, and who will form an investment grade asset, but who may not fit neatly into the very automated and sometimes rigid parameters set by the banks. We call this type of loan complex prime. Within the description, there are prevailing underlying drivers for people choosing to borrow with us. In addition to having the broadest product range of Australia's non-bank lenders, some borrowers simply require the tailored approach, responsiveness and flexibility that can only be achieved when you speak directly to the credit decision maker. Consider a self-employed borrower, someone wanting to borrow through their own self-managed super fund, perhaps a small-scale commercial loan or a small-scale construction loan. All are examples where a bank may not necessarily provide the level of service for borrowers or be willing to facilitate the transaction. Our rigorous, hands-on approach is the foundation of our point of difference and allows us to assess each loan individually on its merits. This is how we extract value from our asset class to pass on to investors as premium yield or outperformance. Focusing again on our borrowers, there are two common myths or misunderstandings about the loans that we offer. Let me speak to the first myth, that our loans may be of lesser credit quality. As we've been demonstrating in recent webinars, portfolio asset quality has been stable and indeed has improved as the AUM has increased. As you can see from the chart on screen, our assets under management have grown significantly in recent years. What's pleasing is the continued upward trend in asset quality. Our exposure to super prime assets has nearly doubled, whereas exposure to the specialist assets have halved. Another key comparison I'd like to draw your attention to is the credit quality of La Trobe Financial borrowers compared to our peers and the big four banks. While we've always undertaken rigorous hands-on credit analysis of our borrowers, we also undertake a credit check from third-party analysis provider Equifax. Equifax are an independent provider of credit searches and reporting in Australia, and among other things, provide a credit score for all borrower applicants. As can be seen by the graph on the screen, our borrower credit scores have aligned more with the banks than our non-bank peers. Notably, in January 2021, our average credit score even went ahead of the Big Four average and has since maintained at or above credit scores of the banks. This is powerful evidence of the continued discipline and focus we place on borrower credit quality. The second myth is that our loans are largely to developers. Let me unequivocally debunk this myth here and now. Our portfolios are fully diversified by security type and location, with conservative, risk-adjusted maximum LVRs to ensure downside protection for investors. We believe that investors should practice diversification within their portfolios, and we are no different. All of this, combined, has seen a local ratings house describe us as the most diversified fund in the sector. On screen now are portfolio parameters for the 12-month term account, which is the flagship offering of the credit fund. You can see an entire set of current holdings metrics via our portfolio snapshot and metrics document, which is updated monthly to our website and is among the most transparent in the sector, if not the entire industry. We'll provide a full update on our current portfolio holdings shortly. Geographically, we ensure the assets broadly follow the Australian population bases to ensure diversification across location. Loans are overwhelmingly metropolitan, and that's by design. We prefer assets within markets that have a wide and deep secondary market. Sectorally, we like an exposure to residential loans and targeted exposures to non-residential sectors such as commercial, light industrial, development finance, vacant land and rural. As you can see, our exposure to residential loans is 61.7%. Let's get back to that myth around development loans for just a moment. The 12-month term account has a maximum holding of just 15% to construction and development loans, which is a level that balances the need for diversification with the outstanding risk and return profile of the development finance segment as we execute on it. Our present holding of just 6.7% is low, demonstrates prudence and confirms that we are by no means driven by development loans within our portfolios. Our portfolios are diversified and harness the very best attributes of the property credit asset class to deliver low volatility to you, our investors. Now, to give an overview of the products and a deep dive into portfolio performance, I'll hand you to our Director of Client Relationships, Lillian Chin.
Thank you, Michael, and welcome all. As the following slides will demonstrate, there have been no change to our distribution rates, no losses in any of our portfolio accounts, and all of our portfolios have continued in their rebound to pre-COVID settings. We were prepared for a much deeper recession than we experienced, and the upside in economic performance has provided a tremendous tailwind for our portfolios. But, of course, we at all times remain acutely aware of headwinds which may impact portfolios and remain on station to ensure we continue to deliver portfolio reliability and downside protection regardless of market conditions. Let me start with an overview of our investment offerings. Investors will be familiar with our track record of delivering low volatility income across all market cycles with a range of products to suit the risk, return, and duration appetite of investors. All our distribution rates are variable rates, which are reviewed monthly and have strong track records of performance since the inception date of each. As discussed in last month's update, our asset class of property credit can be used in a diversified portfolio holding. With interest rates at historic lows and inflation becoming a talking point for future consideration, a targeted exposure to our investment accounts can add real power to your investment portfolio's income profile. As a brief update, our Classic Notice account aims to provide investors with a reasonably stable and predictable income based on a monthly variable rate of return. We welcome investors using the Classic Notice account in conjunction with a diversified holding across the credit fund. Our 90-day notice account provides a market-leading yield with access to your funds per the fund constitution, generally available on 90 days written notification from our investors. Our 12-month term account now at over $4.3 billion in assets under management and the winner of a 12th consecutive Money Magazine award in the category of Best Credit Fund Mortgages has continued its unblemished record of monthly income, low volatility, and with all maturity redemptions being made on time and in full. The 12-month term account remains the flagship offering of the credit fund, with wide support locally and increasingly from abroad. Our 4-year high-yield credit account offers a premium yield over a longer investment time frame. This account invests into mezzanine, RMBS, and warehouse notes, all of which are originated by La Trobe Financial. Due to the longer time and difference in the underlying asset base, the high-yield credit account seeks a minimum investment of $250,000, whereas the other accounts I mentioned have a minimum investment of just $10. And finally, to our Select investment account, which provides individual peer-to-peer investment opportunities via our investment shopping list with a $1,000 minimum investment. Our peer-to-peer offering is the largest peer-to-peer offering in the Australian market and the only one with ratings from independent rating agencies. Investors select opportunities with the risk, return, and duration profile to suit their own individual investment objectives from our investment shopping list. The investment shopping list is providing an increasing number of opportunities each week, and we recommend visiting our website each Wednesday afternoon from 2:30 Australian Eastern Standard Time to view our updated peer-to-peer investment listings. Of course, if you have any queries about our investment offerings, please do not hesitate to contact our friendly private wealth team on 1-800-818-818. In last month's presentation, we mentioned we would not include future updates on hardship, as the portfolio had well and truly concluded any impacts from hardship loans. For consistency, absolute transparency, and noting the potential for impact due to Victorian COVID lockdowns, we will continue to include hardship for the next few months. In short, hardships peaked and receded swiftly, with no one sector or location overrepresented in our statistics, demonstrating strong borrower cohorts right across our loan book. Across our entire fund loan portfolio of 9,532 loans, just 7 are in hardship. We anticipate no material change to these numbers, but will continue to report on borrower hardships, including an inline item in our monthly portfolio snapshot and matrix. Let's now move on from borrower hardships and turn our focus to borrower arrears. Arrears levels in our portfolios are not only broadly at pre-COVID levels right across our portfolio, but are trending lower with strong borrower performance across all our investor accounts. You can track the rise in arrears and the subsequent organic curing of numbers in a controlled and orderly way. Our house view throughout 2020 was that arrears would increase between 2 to 4%, and this did occur as predicted. However, hardships returned to order ahead of our expectations. Presently, we see very few new borrowers entering arrears, with our short-dated arrears of 30 to 60 days at just 0.3% across the entire credit fund. What's more, our total credit fund arrears sit at just 3%, a low point for any time across the cycle. This demonstrates that our borrowers are in good financial health and making their repayments. As our older dated arrears are worked through over the coming months, we may well see the overall arrears figures fall even further. Now, arrears do tend to be cyclical, so you can anticipate movements up or down across the year. At all times, our mortgage help team works closely with our borrowers to assist as best as possible to return to order. This was certainly the case through 2020 and has really helped driving arrears back to levels we usually see in our longer-term lows. The outcomes have demonstrated the resilience against volatility, which is a hallmark of our strategy and even the asset class itself. These are key considerations for any investors and are key to our unblemished history within our portfolio accounts of providing low volatility income with zero capital losses. Now to our performance dashboard, which is an overview of key metrics and the changes or delta month-on-month across our investment accounts. Let me bring some key figures to your attention. Firstly, May was a big month for net investment flows into the credit fund. We saw a net increase of $192.8 million, which was in fact a record for our credit fund, a sure sign of the renewed confidence of the market for our range of investment offerings and indeed our asset class. Secondly, in May, we opened 706 new investor accounts. This granular, diversified investor base is such a tremendous advantage for our credit fund, with lots of investors from different markets and around the world choosing to invest. Thirdly, arrears, as we spoke to in the previous slide, fell to just 3% across the entire fund, an exceedingly low level that speaks to the disciplined asset selection and the resilience of our asset class to generate low volatility returns. And finally, and perhaps most importantly for US investors, is that again, we have seen no changes to any of our advertised distribution rates, with all our portfolio accounts paying their variable monthly distributions on time and in full. That was the portfolio update with data 30th of May 2021. It demonstrates a continuation of our strong start to the year. It demonstrates continued resilience across the business cycle. It also demonstrates that portfolio impacts from the coronavirus are now over. We look forward to bringing you another portfolio update in our next investor call. Now, to provide you with our house views on a range of economic matters, I will hand over to Troy Stratton. Over to you, Troy.
Thank you, Lillian, and welcome all. As Michael mentioned in the introductory comments, the Australian economy has exceeded all expectations and delivered a V-shaped recovery from the impacts of COVID-19. I will use these next few slides to outline our current economic position, focusing on the topical economic data points of GDP, inflation, and the residential property market. We are witnessing a rebounding economy that is outperforming expectations. Remembering, not that long ago, it was widely held that a recovery from the COVID lockdowns could take years of economic and policy grind to resolve. What we are seeing is a V-shaped recovery, which is now baked into expectations and looks set to continue into the years ahead. Consider gross domestic product, or GDP, which is a measure of the consumption, spending, investment, and output of an economy. Many anticipated a 5 to 7% fall in 2020, which ended at just a 1.1% correction. March quarter figures, which were published earlier this month, put us in an annual positive position of 1.8%. Our economy is now larger than it was before the pandemic. Truly remarkable indeed. We also note our position relative to other G7 economies, also demonstrated on the screen right now. And as you can see, the tremendous results the Australian economy has achieved in a global context. Another reason why we are seeing continued interest from our international investors into our credit fund. Let us now turn to inflation, and in particular, the prospect of increasing inflation. This has been receiving increasing airtime in a lot of economic analysis recently. However, we are yet to see a meaningful driver materialise which may force it upwards. Consider the chart on screen. Inflation has been subdued for some time, but despite its trajectory, investors should be at least mindful of the possibility of movement upwards in the period ahead. After all, inflation erodes the real return of income products. Also, and this is a real key consideration, rising inflation is often a trigger for central banks to raise interest rates. In these moments, investors in fixed rate products can have a double impact of reducing real returns and missing out on the upside of movements in interest rates. The La Trobe Financial portfolio products are, for example, variable rates of return with income determined monthly. This offers an inflation-responsive investment for the market to consider. As we investigate the potential for movements in inflation, there are certain domestic and international factors we will remain close to. Locally, the lack of migration and full employment figures may drive up wages and impact inflation. Likewise, it may also have the effect of creating efficiency gains as we are forced to get smarter at producing more with less human involvement, which can be structurally impactful and important for improved economic conditions going forward. Internationally, we are watching the rebounding US economy and its interest rate settings as a driver of international prices and will report more on this in our coming updates. Indeed, we are also cognizant of inflation in China as a driver of international prices. In May 2021, we saw the largest year-on-year factory gate price gains in over a decade as rising commodity prices took hold. While our floating exchange rate can support us, it may be that we import inflation in the years ahead also. So while we may still be some way off an impactful inflation event, the prospect of rising inflation should be something investors start taking into consideration when planning their portfolio construction into the coming years. Early positioning into inflation-responsive products may add some real value over time. Turning now to house prices, and in May we saw another month of strong price growth. In March, house pricing grew at an annualised 39%, in April by an annualised 21.6%, and in May an annualised 26.4%. While this represents a softening from the March quarter end, it is by any meaningful consideration still very strong rate of growth, noting year-on-year growth of 10.6% per annum across the country. Growth is uniform across all capitals and regions. Capitals are now once again outperforming regionals, but broadly speaking, house prices are surging across the nation, with Sydney the clear leader at an incredible 3% growth in May alone. The test will come late this year and into 2022, when demand is likely to soften on the back of the pause in migration. In the meantime, the Council of Financial Regulators will be watching the monthly prints intently to determine whether careful, calibrated macroprudential regulation will have a role to play. While property has enjoyed a strong rebound, there are signs indicating plenty of positive momentum into the months ahead. Auction clearance rates are testing record highs, and prices are generally not that far beyond previous peaks. New listings are tracking at 15% above the 5-year average, as sellers too have responded. Usually this would soften growth, however, with sales activity 37% higher than 5-year average, inventory levels are low and simply not keeping up with demand. Looking forward, however, we note new dwelling approvals have seen a post-COVID rebound, suggesting a wave of new stock coming on the market and a potential aid to the demand-supply mismatch. With that look at GDP, inflation and residential property, I will now hand back to Michael Watson to conclude the webinar. Over to you, Michael.
Thank you, Troy. That's all we have time for today. Thank you, Lillian, for your update on our portfolios, and to Troy for updating on key economic matters for consideration in 2021. And thank you, our 53,000 investors, for your continued support. The La Trobe Australian Credit Fund remains the leading provider of low volatility, inflation-responsive income products for local and international investors. Our products have been widely regarded in recent years with numerous awards and ratings, including for our 12-month term account, being our 12th consecutive Money Magazine Award winner for Best Credit Fund Mortgages, and a range of other local and international recognitions. You can view these on our website. With an economy in full rebound, but with volatility and record low interest rates, it's never been more timely to underscore the importance of low volatility income products within a diversified portfolio. We remain confident that underlying economic fundamentals, the unified responses from government and our regulators, along with broad support from the wider population, has seen the rebound of our economy all but complete. Australia has returned to a globally envious position and looks set for growth into the coming years ahead. We really appreciate your taking the time to listen to our monthly investor calls, and it's our absolute pleasure to assist you with your investments. Also, with the end of financial year approaching, next month we look forward to updating you on some key performance details from the credit fund over the financial year. If you have any queries at all, please do not hesitate to contact our investor team on 1800 818 818. Thank you.